So now that we have a good understanding about how to approach from a high level perspective building a property portfolio, I wanted to cover in a little bit more detail about how we choose a specific investment property to add to our property portfolio in 2018. Before I get into that, I wanted to cover the main reason that we feel or we choose property investment, and specifically residential property investment, as our vehicle to build our net worth. And the reason for it is a simple demand and supply story. If we look at the data that was released from the Australian Bureau of Statistics in 1997, they predicted that Australia's 2051 population would reach 26.4 million people. Fast forward to 2018, Australia's population has already reached 25 million. This means we're about 30 years ahead of schedule in terms of population growth compared to where we plan to be. And all of these people need somewhere to live. And this means that demand for residential property is going to far outweigh supply, which one of the key determinants of how much housing we actually build comes from our predictions about our population growth. It means there's more people wanting to live in houses than we can, and they're moving here faster than we can build them. In fact, in 2012, the ABS updated their prediction, and they predicted our 2061 population would reach somewhere in the vicinity of 37 to 48 million. Now, we're going to have to wait and see how close this prediction is going to be to reality. But the key point I want you to take out of this is that Australia is growing at an unprecedented rate. In fact, it's the fastest growing developed nation in the world, growing at a rate of 1.6% per annum. Now, we recently partnered with social demographer Mark McCrindle to delve into this a little bit deeper. Now, there's a lot of information on this particular chart, but one of the things I wanted to draw your attention to specifically is trying to answer the question of where is all this population growth coming from? And what we discovered was that it wasn't from the natural increase of population, which represented only 42%. And the natural increase is the difference between births and deaths. The main driver of Australia's unprecedented population growth was net overseas migration. That is, the amount of people coming to Australia, less the amount of people leaving Australia. And that represented 58% of Australia's population growth. And this helps us to answer one of the key questions I get on a daily basis is, if Australia is such a geographically large country, why don't we have enough room to support all this population growth? Well, if the majority of this population growth is coming from net overseas migration, the interesting thing is, from the ABS, they tell us that 83% of the overseas born populations live in capital cities. So this is why we focus a lot of our investment activity within Australia's 5 major capital cities, being Sydney, Melbourne, Brisbane, Adelaide, and Perth. The other key driver of capital growth in property is obviously employment. People want to live close to where they work. Now, if we look at the case of Sydney, Sydney's actually quite geographically dispersed in where we predict by our in-house research team some of the job hotspots that are going to be over the next 10 years. And where this comes from is the government's plan to separate Sydney into 3 distinct cities. The eastern city, which is already very well established, the central city focused around Parramatta, and the western Sydney focused around the new Western Sydney Airport, which is going to be built over the coming years. And the idea behind this 3-city plan is to allow people to live, work, and play within 30 minutes of where they live. Now, a lot of this you should be taking into consideration when making an investment decision. Melbourne tends to be a little bit more CBD centric. So a lot of the job growths that we're seeing by a variety of factors are focused very heavily around the Melbourne CBD, with a few hotspots just around there. Brisbane tends to be focused around the coastline, as you could predict, with the exception of Ipswich, which is subject to a lot of government investment in terms of defence, as well as a couple of major organisations relocating their headquarters to Ipswich, which is why we predict that there's going to be quite a lot of new jobs in the Ipswich region in coming years. The next thing we look at is infrastructure. And infrastructure is something that tends to have quite a large effect around the areas in which the infrastructure actually touches. Now in Sydney, I just wanted to go through a couple of them. The first one is the Sydney Metro, which is at the time of recording causing quite a ruckus within the Sydney CBD and surrounds. However, once complete, it's going to change the way that Sydney-siders transport or get around the city, because of the population growth being Australia's largest city, with Melbourne fast catching up, by the way. It's getting very congested. The second thing I wanted to talk about is the Western Sydney Airport. Now, this is an absolute once-in-a-generation type of piece of infrastructure, and it's going to benefit from the fact that it's been pre-planned to allow for further capacity to even surpass the existing Kingsford Smith Airport over the coming years and decades, and also because it's been pre-planned, so it's not a piece of infrastructure that we've simply thrown in there. And what this means is that it differs from Kingsford Smith Airport because it allows for no flight time restrictions, allowing for 24/7 access to the airport from planes across the globe. And that's going to have a major impact on the Western Sydney area in years to come. In Melbourne, one of the key ones I wanted to bring you up to speed on was the CityLink Tulla widening. I don't know if you've ever flown into Melbourne, but it's quite a trip from Melbourne Airport to Melbourne CBD, and in peak hour traffic it can sometimes take an hour and a half on the bus on the way to the CBD. And I've been put behind and missed appointments because of this. So it's going to be quite amazing once they upgrade this particular road. And obviously that's going to have flow-on effects for the properties that are around that area. In terms of Brisbane, there's a couple that I wanted to point out on Brisbane. And now all of these, you can actually download the specific state property report if you want to go in more detail, that's been prepared by an in-house research team. But the two I wanted to point out to you is the Queen's Wharf precinct. So this is going to be a brand new casino that is going to be completed in 2022 with a hotel and entertainment complex. It's going to completely transform the face of South Brisbane. The second thing I wanted to take your attention to was the Brisbane's second runway. So not a lot of people know about this, but essentially Brisbane's expanding the capacity of their airport and once complete, their capacity will actually rival Hong Kong and Singapore airports. So this gives you a kind of indication of a government in Brisbane that is preparing for future growth in population and tourism. And this is an example of a state that's actually preparing the infrastructure before people come. A lot of the other states have been guilty of letting the people come and then starting to build the infrastructure to try and deal with that population growth. So as an investor, what does this type of information indicate that might be going to happen in Brisbane, which has been flat for a period of time? Another factor that we heavily look at is affordability. When we talk to our investors, we tend to keep them from looking at the most expensive properties in any market. And the reason for that is if you look at this report, this is essentially what they call a decile report. It's a little bit difficult to understand, but the first decile is the 0 to 10% of properties are in that price range. Second decile is 10 to 20. Third is 20 to 30, and so on. But what you can actually see, and this is from an overall Australian property market perspective, is in terms of the capital growth rate, as you go up higher in the decile, so the 70% and above price range, this is where this property market tends to have more fluctuations in their capital growth. And when the media is actually reporting the property market is declining, what they're talking about the overall property market. But because these properties are so high in value, what that means is if they go down, it affects the overall property market. So you need to be really careful where you get your information from. And this is one of the benefits of working with a support team and building a support team around you, particularly one that has their own in-house research team. Another example of affordability is if you look at interstate migration. So, Sydney, who's just gone through a massive property boom where the prices have absolutely exploded, funnily enough, is showing around about 20,000 people a quarter leaving New South Wales. And where are they going? They're either going to Victoria or Queensland. And why is this? Well, simply because they can't afford to live there or enter into the property market. Or on the other side, they've made a lot of money in the Sydney property boom, but they've also realised that they can sell their Sydney property, move up to Queensland, live quite a good lifestyle and buy quite an impressive property and still have money left over. So affordability plays a big part in the types of properties that we recommend for our clients. So when we combine it all, we have our overall property portfolio approach where we encourage people to buy 4 or more properties because this is the amount of properties that people are going to need in order to build the net equity that they need to retire on. We adopt a long-term mentality. We want to buy our properties and hold them over the long term to allow the property market to do the heavy lifting. We want to buy at least one with a land component because a land component tends to go up faster in capital value when compared to apartments. But we also want apartments and other assets within our portfolio because apartments help us with our cash flow in order to hold on to the investment with land over the long term. And we also want to have properties in at least 2 cities. And the reason why we want to have that is it allows us to take advantage of different market cycles because each city moves in a different cycle. For example, Sydney has just gone through a boom. Brisbane's been flat. Where do you think the next cycle is going to be? So, and in regards to a specific investment opportunity, we try to keep things basic. There's a lot of data out there that we condense and try and make it into something that people can understand and seems logical and reasonable. So you could sit there and have a look at what the auction clearance rates were last weekend and make an investment decision on that. Or you can take a wider view, is what we advocate, and look at the fundamentals of the property and have faith in the property market doing the heavy lifting over time. So what are the fundamentals of the property market that we look for when we pick a specific investment? Where is there going to be above average population growth? Where are the major hubs of employment? We probably want to look at investing around them. Where is the major infrastructure going and what corridors are they going to affect? What decile range, how affordable are these properties? Because we want our properties from both a rental and a owner-occupier perspective to appeal to the broadest range of market as possible. And put all that together and you have a fundamentally sound investment that you can hold on to for the long term And it might take 10 years, it might take 15 years, it might take less, but eventually that property will double in value and allow you to keep on building your property portfolio. On top of this, where all these coincide, we look for something with a little bit of an X factor. And what do we mean by an X factor? Well, I'll give you an example from one of the developments we recently helped some of our investors to invest in. Now, this particular developer is always looking for something with a little bit of an edge or an X factor. So what they did is they purchased 3 Tesla cars for the apartment building, and each residence has the ability to book out the Tesla car and use it free of charge, mind you, to go about their daily activities. Now, little things like this, whether it be a car, a movie theatre, or something like that, is what actually drives above market rents and capital growth, because people are generally moving towards a higher quality apartment. In a boom market, it's perfectly fine to go and buy any old box out there. But as we progress and we move towards a more denser, getting used to a more denser type of living, the flight to quality has become very apparent, and it's this combination of the fundamental factors and some sort of X factor which is outperforming the market.